you listening knew for sure that it wasn't transitory. Lumber had been going up. Labor had been going up. Used cars had been going up. Food had been going up. Hello and welcome. My name is Gino Barbaro, and I am one of the co-founders of Jake and Gino. And in this how-to lesson this week, I really want to stress it's really important. I've been getting a lot of negative news from multifamily investors saying, oh, the sky's falling. Now is not the right time. In this week's edition, I'm really going to be discussing why now is the right time and the similarities between 2008, 2009, and what's going on right now in this current economy. First reason, I'm going to jump right into it because I'm fired up about this topic. I love talking about this because when everyone is running to the exits, this is when people who are serious, who know about investing, this is the opportunity. Foreclosures are up. You're seeing foreclosures everywhere, especially in the multifamily space. I mean, a couple of years ago, it would be unfathomable to think that people would turn in their keys. Rates were low. Jobs were plentiful. Money was cheap. Rents were going up. No one ever even saw or thought about foreclosures happening. And what's going on right now? Some are very public out there. In '08, people would just give back their keys. You wouldn't hear that much publicity. The internet had not taken root back then as it has now. Right now, it's very public. A lot of people are actually turning in their keys and saying, hey, I can't deal with this. I took out debt at 3%. Now debt's at 9%. We're going to talk about all of the other expenses that have gone up, but there's so much more publicized, and where foreclosures happen means that prices are going to start to reset. So that's the first thing that we see going on. Happened back in '08, '09. As you hit the recession, things start going up bad for a lot of people, especially people who aren't operating their properties. It's really sexy to jump in there to buy these properties and to finance them, but a lot of these operators are not managing their properties. The second reason, back in '08, I'm going to throw out a name. I want to know if you ever heard of this name, and just think to yourself, if you haven't, what rock have you been living under? The name is Bernie Madoff. Now, what's the first thing that comes to your mind when you hear Bernie Madoff? Ponzi scheme, and a really big Ponzi scheme. Well, fast forward to today, I'm going to throw out another name, Sam Bankman-Fried. Have you heard that name? What about Elizabeth Holmes with Theranos? What about crypto? All those crypto scams going on, all the NFTs. Ponzi schemes start going up as you get later on into the cycle because people have what we call FOMO, fear of missing out. As money continues to stay cheap in this part of the cycle and it goes on, these Ponzi schemes start popping up. There were so many back in '08 and '09 that just ended up crumbling because the money dried up. And that's what you're seeing going on in the last 12 to 18 months here. All of a sudden, these criminals, as they are getting caught holding the bag. There's no one else to go out and to fleece. And you're seeing a lot of these go out there. So remember, foreclosures up, lots of Ponzi schemes. Now, this third one, bank failures. We've had some really massive bank failures. And what precedes financial crises, as it happened in '08, and as it seems as if it's happening right now, these banks, and they're really large ones, have been failing. Now, there is one stipulation, one difference between '08 and now. The banks are really much better capitalized now than they were back in '08 because of the government giving all this money over the last 3 years, printing all this money and flushing it into the financial system because the government knew they wanted to prevent something happening as if it had happened in '08. Do you remember what happened in '08? The credit crisis, everything seized up. Well, in 2020, with the pandemic and everything shutting down, the government, in their infinite wisdom, they actually told the Fed, we need to flood the market with a lot of money. The problem is they flooded it with too much money. So this bank failure thing is really, really interesting to see. A lot of that's happened right now is other people have stepped in. Community banks are having problems right now because rates are so high. It's really difficult to get loans. So other people have stepped into place. If you're in multifamily, check out the credit union space. The credit unions are doing a good job lending on multifamily assets. So it's really important to take a look at that. Now, the fourth one happened in '08, '06, '07, '08, and it's happening over the last 12 to 18 months here. Rates are going up. Now, why are rates going up? Well, we have inflation. We thought it was transitory, or so-called the experts knew it, but you listening knew for sure that it wasn't transitory. Lumber had been going up. Labor had been going up. Used cars had been going up. Food had been going up. All these prices were going up, and it wasn't transitory. It was happening, and if the feds and the government didn't do something about it, it would continue. So instead of taking that effect and saying, hey, let's raise interest rates, because that's what the Fed's job, everybody, is to take care of inflation. That's what their number one priority is to curb inflation. They should have raised rates sooner, but in my estimation, there was an election cycle in November of 2022. So they didn't raise rates quick enough. And now you may be saying, well, how do you know that, Gino? That's my conspiracy theory. Why didn't they raise them sooner? What happened was they raised them too quickly, and it happened in such a short period of time that it sort of shocked the system. Rates going up in 08 slows the economy down. Rates going up now, they want to have the effect of the economy slowing down and curtailing inflation. Now, are they going to continue to raise rates? Some people say yes. Some people say no. I don't have a crystal ball. All I know is that once rates go up, the economy does tend to slow down. Very similar thing happened in 08. When that happens, prices tend to come down. And we're seeing right now the next one. The demand is dropping to invest. There's a lot less people out there investing in these assets because all of a sudden the money's starting to dry up. People are afraid. And when there's no, jubilance or there's no exuberance in the market, things start to tamp down. That's what you want. You want less buyers bidding. And that's what happened in 08 and 09. All of a sudden people are on the sidelines. They're afraid. There's no access to capital. There's not as much demand for the assets. And we're seeing that happen right now. Now, this next one, debt markets. These debt markets are much more challenging than they were a year or 2 years ago. All of a sudden, LTVs of 80% are goodbye with the Fannies and Freddies. Now you're looking at 65% because they know they want you to have more skin in the game. It's important for them to do that. So you're seeing back in 06 and 07, debt markets became more challenging, and that's what you're seeing now. And I want you to write this down because this is truly important as a multifamily investor. Debt is the circulatory engine of the economy. When debt seizes up, and that's what the Fed's trying to do, all of a sudden the economy slows down. The economy slows down. What happens? That demand and that inflation comes down. That's what their aim has been for the last 12 months. And for investors, it's great. That's what you want. You want that demand to slow. This next one, when Jake and I started investing back in 2011, 2012, seller financing was really pretty hot. And seller financing really works when there's a buyer's market. We bought our first deal and our fourth deal on seller financing. And ironically enough, this past January, we closed on an asset and we had seller financing. Now, why is that? I just mentioned it. Debt markets are seizing up. It's a lot harder. And all of a sudden, as you as the seller are saying to yourself a year or two ago, I can throw this asset on the market. I can sell it in 10 minutes. That's not the case anymore. It's a lot more challenging. So you're seeing assets that are distressed, that have either occupancy issues or there's a lot of CapEx. They can't get financing. So go out there and start looking for seller financing. Now, this next one, really important. Asset prices are resetting. I live here in St. Augustine, Florida. I remember a year ago, people would put their house in the market. A house would be sold above asking. And I'm saying to myself, what is going on here? Well, now what I'm seeing is a flood of homes coming on the market. They're staying on the market much longer, like they did in 07 and 08, and prices have dropped in this market at least 20% on average in a lot of areas. Now, not every market is the same. Not every city is the same. But I'll guarantee you over the board, the next 6 to 12 months, as interest rates continue to climb and as this recession, I think it's a recession, as this economy continues to falter or just be stagnant, you're going to see those asset prices continue to come down. Because when you're looking at a cost of capital of 3%, that's what interest rates were, 3.5% for multifamily. And now you're looking at assets that are 6.5% to 7%. Asset prices have to fall. That's why there hasn't been as much activity over the last 6 months, because sellers have not come to the realization that, I want the price that you told me 2 years ago. Well, that price 2 years ago was based on rents rising at 10% clips. We're talking about expenses that weren't going crazy, and also interest rates were at 3%. I can't give you that price. That's why a lot of sellers don't want to come to market. But the ones that do have to come to market, they're the ones who are discounting their prices. And this last one is really interesting. because when Jake and I started out in 2010 and 2011, we were newbies, and yet brokers wanted to talk to us. There wasn't as much activity. There wasn't a lot of sales going on. There were deals on LoopNet left there to die. And guess what? The brokers are calling us back now. They're cold calling. They're sending out emails. That's a good sign for an investor. Whereas a year ago, a lot of our students would say, Gino, I'm reaching out to these brokers. They're not giving me the time of day. They didn't have to. That was where we were in that part of the market cycle. It was a seller's market cycle. Things are starting to revert back. But the only way you take advantage of that is to get into the game now. Don't wait, quote unquote, until the market crashes or the economy crashes. That's what a lot of people do. They say, I'm going to wait till the time is right. The time is right only when you're ready. And for me, back in 2010 and 2011, I was ready to invest. I didn't know what I was getting myself into. I didn't know that's probably one of the best times in history to start investing because asset prices were so low. There was such little demand. The economy was terrible. It was hard to raise capital, but there were tons of opportunity. And I see a lot of the similarities that we had back in '08 and '09 cropping up right now. I think the only big difference between 2008 and 2009, one of the big differences, at least in my estimation, and we have seen right now is we have a ton of money still left in the system with PPP loans, with EIDL, and all of these other stimulus programs out there that we didn't have in '08. And you've seen a big run up in real estate. A lot of the people who own homes right now are not underwater like they were back in '08 and '09. So that money is still holding us a little bit afloat. But once that dries up, once the sentiment gets negative, you're going to see these asset prices quickly, in my estimation, once again, turn. So what do you need to do? What are the next steps that you need to do as an investor or somebody sitting on the sidelines saying, I want to get into the game? Well, the first thing, go to jakeandgino.com/webinar. You got to start educating yourself. You have to start getting into the game and start listening to people who have done the business. Start understanding all of the different strategies and techniques that you need to learn in multifamily because it's not just one strategy. You can sell or finance deals right now. You can buy deals by yourself. You can partner up with other people. You can raise capital for other deals. You become a syndicator, raising capital for your own deals. There's so many different ways to get into multifamily, and you need to start educating yourself. I think the next thing you need to do as an investor, what you need really to focus on is yourself. What are your goals? What are you trying to accomplish in real estate? And if you're not clear about that, you're going to be stuck and you're going to be saying to yourself, I'm not sure how to get into this. For Jake and myself, when we first started out, real simple. What we wanted to get out of multifamily, we wanted to just generate a little bit of passive income to pay some of our bills and then ultimately let that take our jobs, let that replace our jobs, the money we're making from our jobs and get into multifamily full time. That's what we wanted to do. For you, what does that look like for you? Do you just want to continue to build your portfolio for retirement income? Do you want to get into it full time? Do you want to start investing money that you have in a 401k, put it into a self-directed IRA and start investing with others? You have to answer that question for yourself very clearly because it's really important what your goals are. Because then that, from that perspective, you can start selecting the strategies that you need to incorporate to hit those goals. And I think ultimately the third step, before anything else, select the market. Select one or two markets, preferably when you're first starting out. Choose one market. Become an expert in that market. Learn the job numbers, learn the population numbers, learn the median income numbers, learn the numbers that you need to excel in that market and become an expert in that market. So when you do ultimately start talking to brokers and other people in the market, you'll know exactly what they're talking about. Oh, that property on King Street, not really crazy about that area. The median income is not high enough for me. Oh, but that one you have on Washington Street, I love that. I like the unit mix. As you can see, I learned the lingo and I'm learning the lingo and I'm also understanding the market. So let me recap this for you. '08, financial crisis, Great Recession, Great Reset, whatever you want to call it. Also a great opportunity for a lot of people to create massive wealth. 2021, 2022, we have this huge run up after the pandemic, tons of money going into these assets. All of a sudden, the Fed puts the brakes, starts raising interest rates. And what happens? The demand falls. We're going into a recession. Things are starting to slow down. The sentiment becomes negative, just like it happened in '08 and '09. I promise you, there are opportunities out there. We've closed on 2 assets already this year. We're getting ready to sign on a 3rd deal this year to bring us up to over 300 units for this year. And I've been saying this to our students. Now is the time to get prepared, because as these assets start to reset, you want to learn. You want to have these relationships. You want to be able to start talking to investors, start cultivating those relationships with the investors and your family and friends. But not only that, the brokers, the people who are the gatekeepers in these markets that are going to send you deals. Now, listen, if you have any questions, just reach out to me. It's Gino@jakeandgino.com. If you want a resource, I love to share the Creative Cash book that we've written. It has seller financing. It has master lease options. It talks about the market cycle and what's going on currently now, and how it's very similar to what it was back in 08 and 09, and how seller financing is an awesome way to get into your first real estate deal or to continue to close deals. So just reach out to me, Gino@jakeandgino.com. Listen, I want to thank you for listening. It's been an honor and a privilege to share this show with you, because as I look back on the past and I say to myself, man, 08, 09 was a dark time in my life. I was still working at the restaurant. It was still a struggle for me. I hadn't started really investing with Jake, but that was the catalyst that got me going. I understood what my why was. I got educated. Then I started investing in a really difficult market cycle. And I think that's the market cycle we're getting into, but there's so much opportunity. So once again, thanks again, and we will see you on the next show. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.